Hi guys, welcome back to another video. My name is Josh, and in this video I'll be sharing with you my top 3 stocks for November 2020. And as always, this is not financial advice nor a recommendation to buy, hold or sell any of these stocks. You can check out the full disclaimer down in the description box below. And if you enjoy content like this, be sure to hit like and subscribe as well. So without further ado, let's get into stock number 1. Stock number 1 here is Oceania Healthcare Limited, stock ticker OCA, and this is listed on the New Zealand exchange as well as the Australian stock market. In the past 3 years since IPOing in 2017, the stock has returned a 72.15% return. It has a market cap of 820 million New Zealand dollars and a dividend yield of 1.72%. Now, if you don't know what Oceania Healthcare does, Oceania Healthcare operates in the New Zealand residential aged care and retirement village sectors and is the leading provider of premium healthcare services in New Zealand. And talking about premium, they own really premium units. So for example, they own the Sands in Browns Bay, Auckland. And this is their most premium development, I should say. Being close to the Northern Motorway, it's really close to any cafes, shops and restaurants in the North Shore, as well as that it's facing the beach. And you might remember it was in the Herald last year that the apartments in this complex is selling for an average price of $1 million. And talk at the time was that the most premium units facing the beach was selling for roughly $2.5 million. Okay, so Oceania is positioned as a premium healthcare provider, and they also have some of the most premium locations of retirement villages in New Zealand. In terms of business model, Oceania Healthcare has 4 different streams of income. So the first one is the village and care fee. So this is like the weekly fee that Oceania charges to its residents for fees like cooking or cleaning their units. This is an ongoing weekly fee, some of which is subsidized by the government. Next up, they have development margins. So when Oceania develops a unit, builds it up and sells it on, the profit that they make is essentially the development margin. And so for example, if it costs them $500,000 to build a unit and they then sell it for $600,000, then they make a $100,000 development margin on any new units that they sell. And the other 2 that are on this list is Deferred Management Fee, or otherwise known as DMF, and the resale margin. And I'll explain this using a graph here. So this is an illustration that I got from one of the Infratil share presentations, and this will help explain what the DMF fee and the resale margins, what they are. So say for example, a resident moves into a retirement village, they acquire what you call an occupation right agreement, or otherwise known as ORA, O-R-A, and this allows them to occupy a unit. And say for example, an ORA costs them $200,000 here at year 0. So the resident is moving in and they pay Oceania Healthcare for the ORA for $200,000. The DMF is an amount equal to a capped percentage of the ORA that is charged by Oceania as a management fee for the right of use and enjoyment of the common areas of the village. And industry standard is to have a DMF of 30% or 10% a year for the first 3 years. The deferred management fee is payable to Oceania by the resident on termination of the ORA. So say for example, in year 10, the resident moves out. The resident gets back $140,000, but Oceania keeps $60,000 of the deferred management fee. And that's because they have a 30% DMF. So remember, it is 10% for the first 3 years. So it makes no difference if the resident leaves at year 3 versus year 10. They still get charged $60,000 DMF, which is 30% of $200,000. Now, in year 10, the unit is worth $269,000, assuming you have house price inflation of 3% per year for 10 years. If Oceania then resells this unit to another incoming resident for $269,000, they essentially make a $69,000 resale gain. Okay, so this is a resale gain of $69,000. So that is what a resale gain is and what the DMF fee is essentially. And this is why retirement villages are so capital efficient, because firstly, they get $200,000 when a resident moves in. They can use that $200,000 to then go and build another unit. And when the resident moves out, these retirement villages don't really have to pay the outgoing resident the money until another incoming resident has bought the unit. So they won't get their $140,000 until another person comes in and pays Oceania $269,000. So they don't have to then, borrow from their bank $200,000 to pay the resident back $140,000. Someone else incoming will pay this $140,000. And at the same time, they make a resale gain of $69,000. So that is a very capital efficient business model. And that is why I love retirement villages so much. I love Somerset so much. But now I think I like Oceania more than Somerset. So how does Oceania compare to its competitors, you might ask? Well, according to the JLL Research white paper on retirement villages, Ryman has the largest average village size at 195 units per village, with MetLife just behind at 182 units and Somerset at 157 units. Arvida, Bupa, and Oceania have similar number of villages, but they have much smaller villages on average. As you can see here, they have quite similar numbers to MetLife and Somerset, but their units are much lower compared to MetLife and Somerset. And the reason being is that they have a greater focus on care offering. So Oceania is very different portfolio-wise compared to the big three, Ryman, MetLife, and Somerset, who focus more on independent living. And this is consistent with what management is telling us, that Oceania is focused on a care strategy, that is to develop premium rooms that are sold under an occupation right agreement. So we can see that the standard beds have been decreasing and they've been increasing their care suites and their premium villas and apartments because they can charge the deferred management fee on these, but they can't on the beds. So that's the reason why they are transforming their portfolio, essentially a higher focus on care as well as getting more profits through the DMF and premium charges. Oceania is differentiating themselves as a needs-based provider, and this means that there is less demand elasticity when it comes to moving into their village. So for example, if you're old and you're sick, then you need the care service that Oceania provides. Therefore, you're moving into the village. Whereas if you're old but you're healthy, then you might decide to just chill at home and then later on only move into an independent living unit at Somerset, for example. So because Oceania has a needs-based business, they are a more consistent business and there's always demand for that type of product. Now, moving on to their FY 2020 highlights, we can see that underlying EBITDA has been flat for the past couple years. Underlying net profit has actually decreased in FY 2020. And the reason being is that due to the Rona, there were restrictions around level 3s and level 4s during the FY 20 period. And what that meant was that many of the sales could not settle in May 2020. And as a consequence, this had shifted sales into the next year. Okay, so we should expect FY 2021 to be much higher than 2020. Operating cash flows wise, Oceania is still doing really well with a 10 million increase and total assets have still been increasing. In terms of the analyst forecasts, Oceania Healthcare is currently trading at a forward PE of 13.4 times, which is pretty reasonable compared to the general market. And analysts are also forecasting that they pay a 2.76% dividend yield on today's share price of $1.35. So I think this is a very attractive business at a very reasonable price. And as such, I actually have been acquiring Oceania shares in the public portfolio. So this is definitely one to watch for the month of November 2020. The next stock that I have on this list was on last month's list, but I do have to mention it again this month, and that is A2 Milk. So A2 Milk is a premium branded dairy nutritional company uniquely focused on products containing the A2 protein type. As you can see here, their two key products are the infant formula and liquid milk products. So the last month I talked about the stock. I go into a bit more detail, so if you want to see that, be sure to check that in the link above. And also I think yesterday Tom posted a analysis on the stock, so that is worth checking out. Tom's a great guy. Make sure you check out his channel if you don't know his channel already. So last week I talked about A2 Milk. The share price was trading at $16.29 per share. Today the share price is trading at $14.30 35 cents. So that is a drop of roughly 11.75% in the past 3 weeks or so. And I won't go into too much detail because I already did last month, but there wasn't any new news that have come out that should warrant such a decrease. It was more like the market was re-rating A2 milk. And the reason for that really is the profit downgrade due to the short-term impact on the Daigou channel because of the Roni Rona. And what that meant was that the profit this year wasn't expected to be as much as what analysts were forecasting. Now let's take a look at what analysts are forecasting. So for FY 2021, on today's share price, analysts are forecasting a forward PE ratio of 26.9 times. And I think that is really reasonable if you compare that to prior years' PE ratios. So if you look in FY 18, it was 43.6 times. And then 19 was 37.8 times, and then actually increased to 38.5 times in 2020. And that is because, you can see the share price has actually increased significantly in FY 2020. And now that the share price has dropped, you are paying a much lower valuation multiple. In other words, if you're buying now, you're paying a much lower valuation multiple for the company, but at the same time, the company is expected to grow less this year than what analysts were expecting, which is why it is on a lower PE multiple. Me personally, I think this is a really attractive valuation. I was really close to pulling the trigger, but I will wait to roughly $13 before buying, okay? Because I understand that this is a great company, but it is slowing down, and I don't know how slow it will go. The Roni Rona situation might continue, and this Daigou impact might drag along. I am still taking a wait and see approach, but I think, if the share price drops below 13, then I will start a position. And remember, this is not financial advice, and don't do anything just because I am doing it. Okay. What's interesting as well is that analysts are forecasting a dividend payment in 22 and 23. So they expect a dividend yield of 0.22%, which isn't much, but it's a good start. And then it increases to 1.34%. And the reason being is that the A2 Milk Company has a huge cash balance. And management has alluded that they won't be paying a dividend this year. They'll be spending on other capex items, but it is a possibility in FY 22 and 23 that they might pay a dividend. So I am very interested because I see this, I like, right? I am a junkie for dividends, especially on New Zealand stocks. So I see this, I like, and the valuation is also really reasonable. I will pull the trigger when it goes below $13. So this is still on my watch list for that reason, and I am keeping a very close eye on this. So stock number 3 on this list that I have here is Alibaba, so stock ticker BABA, and this is listed on the New York Stock Exchange as an ADR. And Alibaba is a Chinese multinational technology company specializing in e-commerce, retail, internet, and technology. And over the past year or so, Alibaba has experienced a huge gain, and they are currently up 56.25%. They have a market cap of $778 billion US. And over the past 5 years, we can see Alibaba has grew tremendously. So Baba's revenue has gone from $15.3 billion US to $77.1 billion US from 2016 to 2020. And likewise, non-GAAP net income has also increased from $6.5 billion to $20 billion in 2020. So that represents a compounded annual growth rate, or CAGR, of 49.83% for revenue over the past 5 years, and a CAGR of 32.65% for non-GAAP income over that 5 years as well. The share price is down today, even though the entire market is up to 2.5%. And this is because they did report their earnings results today. They reported their Q2 results. We can see here that non-GAAP diluted earnings was at $4.83. And that is firmly ahead of the forecast of $2.08. But group revenue missed. They only achieved $22.8 billion US dollars compared to a $23 billion estimate. However, if you look at the Chinese yuan terms, Alibaba's revenue was actually 155 billion RMB compared to the forecast of $154 billion. In other words, Alibaba did hit their RMB revenue target, but they missed their USD target due to the exchange rates, and they also did hit their earnings per share estimate. So I think this is a decent result for Baba. In terms of what Baba actually owns, they own all of these companies in core commerce, cloud computing, digital media and entertainment, and innovative initiatives and others. Okay, and we can see that core commerce is growing steadily at 29% year on year. Cloud computing is a beast at 60% year on year, and the other initiatives are growing 8 to 10% respectively. What I'm really excited about is the cloud computing segment, because as you can see here, adjusted EBITDA has actually closed in at -1%. So they're still making a loss currently on this segment. But if you compare that to prior years, they were actually operating at a loss of 5% in FY18, and then in FY19 they were operating at a loss of roughly 3%. So currently the losses are getting smaller, and I expect cloud computing to be profitable coming next year. Core commerce is currently their bread and butter though. They are making a 35% EBITDA margin on core commerce. So this is driving the entire business, and then they're investing in other growth categories over here. But overall though, consolidated, they are profitable at a 27% EBITDA margin. Similar to the other big tech companies, Baba is benefiting from the impact of Rona, driven by growth in customers in the internet, finance, and retail industries. What was interesting as well was that 60% of Chinese listed companies are actually on Alibaba's cloud. So that is a huge market share that they have in terms of the cloud in China. And this whole cloud computing space is just getting started, and I think there's lots of room ahead to grow in the years to come. And we can see here as well that their non-GAAP net income has actually increased 44% year on year. So the company is still heading in the right direction. But in the past 5 days, the share price is down 6.74%. And the reason why that is because of the Ant Group IPO facing a 6 months delay after Beijing intervention. Alibaba owns a 33% stake in Ant Group. So this article here says that Ant Group's initial public offering could be delayed by at least 6 months, and its valuation sharply reduced after Beijing abruptly halted its trading debut this week, people directly involved in the deal and investors said. Shares of China's biggest fintech group, which was set to raise 37 billion in the world's largest IPO, were due to begin trading in Shanghai and Hong Kong on Thursday. So the IPO was called off on the eve of the IPO, and now they're saying that the valuation might be sharply reduced, which is why there is a drop in Alibaba's share price. However, it doesn't have any impact on the operations of Alibaba. And if you're thinking about their most recent result, they're still growing tremendously at 44% on a non-GAAP income basis. And if you take the quarter's results, multiply that by 4, and you calculate the underlying price to earnings ratio, I calculate a price to earnings ratio of roughly 27 times. 27 times for a company that is growing at a 40% clip is a really reasonable valuation in my mind. And there are other reasons why you might also like the stock now. And that's because of the presidential election. So Biden is expected to win. The markets are forecasting Biden to win. And Biden is known as a friendlier guy towards China. And he might look to restore normal trade relations with China. And I think that will give Baba an easier time. And another thing to note as well is that the Singles Day is on the 11th of November, and Alibaba already had kicked off an early Singles Day event from the 1st to the 3rd of November, and then the proper Singles Day event on the 11th of November. So that will be a big day for Alibaba, and it will be exciting to see how their sales go during that day. if they have a really big day, then you can expect Baba's share price to take off. So there are lots of things to look forward to in terms of Baba, and that's why I have the stock on my watch list. And another reason why I am looking into Baba is because I don't have any direct holdings in any Chinese stocks. So having a direct holding in Baba will add an increased level of diversification in terms of my portfolio. So that rounds up the top 3 stocks that I have in November. Let me know what you think of my list for November. If you enjoyed today's video, be sure to hit like as well, and hope you enjoyed this video. Until next time, take care.